An IUL is a scam, right? Those are all the comments that we hear all over social media. Well, today in this video, I'm going to break down exactly what's hype, what's real, and how to tell the difference. By the end of this video, you'll know if an IUL is a smart tool for you and your family, or if you should just pass on it. Welcome back to my channel. I'm Christopher Vaughn with CVAF Insurance Agency. Here we help people protect their legacy, build wealth, and secure their family's future. So let's dive into IULs. What is an IUL? An IUL is basically a permanent type of life insurance. It has a death benefit to protect your family, and it has cash value that grows over time. So then why do some people say IULs are a scam? Usually, basically, there's three reasons that make people say that IULs are a scam. Number one, bad design. What does that mean? Low funding, high death benefits based on agents receiving a higher commission. Number two, bad expectations. So agents basically promising stock market returns with no risks. And that is not true. There's a cap, there's costs, and there's maintenance fees. And there can be policy risk if mismanaged. And number three, bad maintenance and bad management. Basically, that means policies are just set up and then forgotten. Most IULs are flexible by design, and that's very good if they're properly managed. So an IUL is definitely not a scam, but poor design, hype, and neglect can definitely create bad outcomes. So how does the cash value really grow? Each year or each month, depending on the policy, the company looks at the index performance. So if the index goes up, you get interest credited up to a cap or at your participation rate. And if the index goes down, the floor, usually that means you get a 0% for that period. So if the index goes up, you get interest credited up to a cap or at your participation rate. So what is a cap? A cap is basically just a ceiling on the amount that an insurer will carry for a particular period of time. The floor is basically protection from market downsides, which usually is at 0%. So what does that mean? That means that no market loss is actually debited against your cash value. It is protected with the 0% floor cap. Meanwhile, inside the policy, there are costs of insurance and policy expenses. These all can vary by age, health, and the design of the policy. That's why proper funding matters. You want enough monthly premium going in to overcome costs and build real equity. One of the biggest attractions to an IUL policy is the access to the cash value. You can have access to the cash value while still living via withdrawals and or loans to the policy. And if you keep the policy in force, meaning keep up with your payments and follow the rules under current tax law, the cash that you withdraw can be tax advantaged. But the only setback is if you overloan, the policy can lapse. So what do we mean by lapse? That means you can face taxes and also lose your coverage. So what is the translation to that? That means that the loans can be a powerful tax advantage tool, but you need to use them with a plan. So who is an IUL for? Well, IULs are great for people who want lifelong coverage and a potential of cash growth. They're also great for people who have the discipline to fund aggressively and manage the account yearly. And it's great for people who actually value the downside protection more than just chasing every bit of the upside value. And it's also a great option in life later for people who want college funding, maybe some type of opportunity fund, start a business, and or legacy planning. But now there's situations where it also might not fit. An IUL might not be a great fit if you want the absolute lowest death cost benefit, meaning death benefit payout. If that's your option, then maybe a term policy works better for you. It's also not a good fit if you don't fund it adequately or review it yearly. Or it could also be a bad fit for those who constantly draw from the policy with no plan or no strategy in place. So let's debunk a few myths about IULs. Myth number one, IULs are guaranteed to beat the market. Bam! That is false. Caps and participation rates limit upside, and costs do exist. So what does that mean? That means it's about smoother growth and not beat the market. Myth number two, you can't lose money. Wrong again. You can't avoid market losses due to the floor, but there are still some costs that come out of the policy. So if it's underfunded and mismanaged, your cash value can decrease and your policy can lapse. Myth number three, loans are free money. Incorrect. Loans have costs and also mechanics. But if used wisely, it can be a powerful tool. But if used incorrectly, it can be very dangerous. Myth number four, all IULs are the same. No, they're not. The designs, different carriers, different caps, different participation, different bonuses, riders, it all varies, and the cost varies as well. So your design matters. Myth number five, it's too complicated. It is very detailed, but it's not impossible. With the right advisor, we can set guardrails and set your policy up so that you do not drift and your coverage doesn't lapse. So now let's review 5 ways you can avoid setting up a bad IUL for you and your family. Number 1, you're going to want to overfund. So what does that mean? That means you're going to want to prioritize cash value early. Don't chase high death benefits with low monthly premiums. Number 2, conservative assumptions. So if your illustration needs rosy returns to work, you're going to want to walk away. Number 3, you're going to want to have annual checkups. Review your caps, your costs, your participation, and you're going to want to adjust premiums accordingly. Number 4, have your loan strategy in writing. So if you plan to use policy loans, document in writing how, why, and how you're going to keep it safe. And number 5, the most important of all, work with a pro that can actually show you all the downsides. So if they only try to sell you sizzle and don't talk to you about all the downsides, the risk, and how to protect your policy, maybe they're not the people to work with. So let's give a brief example about how a cap and a floor works inside your IUL life insurance policy. Let's say your policy has 0% floor and a 10% cap with 100% participation. So what does that actually mean? That means in a year, your index is actually up 18% and your credit might be the 10% cap. And in a flat down year, your credit might be 0%, but you didn't take any market hits inside the policy. So over time, there are no negative years credited, plus the compounding can create steady growth inside the policy. You're going to want to make sure though that it's funded well and managed properly. So again, it's all about smoother, protected accumulation, not moonshots and trying to beat the market. So are IULs a scam? Absolutely not. They're a powerful tool, and in the right hands with the proper design, they can protect your family, build wealth, flexibility, and tax advantage growth. But in the wrong hands, with the wrong agent, mismanagement, they can disappoint and become dangerous. If you want a custom design IUL policy to fit your family, hit the link in my description and set up your consultation today. And remember, it's not for you, it's for them.